welcome to Week in Markets. Today I'm joined by Lexi Herriott, investment analyst, who's going to walk us through the main events of the week. Lexi, let's start with the Bank of England. The previous week we had the Federal Reserve lower interest rates by 0.25%. The European Central Bank left interest rates unchanged, so it was the Bank of England in focus this week. What was the outcome?
Yeah, yesterday the Bank of England kept rates unchanged at 4%, but 4 out of 9 members actually voted for a cut. So this is signalling a possible rate cut in next month's meeting, depending on economic data and the budget on November the 26th. Yep. Heading into the meeting, the Bank of England was faced with the challenge of weaker labour markets, but inflation persistently above target of 2%. But inflation is expected to have now peaked in the UK and is expected to fall from 3.8% in September to the 2% target by the fourth quarter of 2027. It's also expected that growth will slow and next year before picking up again in 2027. So this backdrop of improving inflation and slower growth should be supportive of gradual rate reductions. And Governor Andrew Bailey in his statement indicated that rates could be cut if disinflation becomes more established, and the expectation that rates will get to 3.5% next year is in line with his current outlook.
Thank you. And I think it's not unusual to see the Bank of England hold interest rates steady when there's an upcoming the autumn budget, where they want to really understand the tax implications from the budget, and obviously they need to see or gain greater confidence that disinflation or softer inflation coming through is there before adjusting interest rates. Great. I suppose just thinking about the market reaction, I suppose if we focus on the UK government bond yields, we saw bond yields fall, so the prices increased following the news. They've given some of that back, but underperformed US government bond yields, which rallied quite aggressively yesterday after we had some data which suggested that the US economy may be slowing, particularly the labour markets, which came through when we look at the number of job cuts in the private sector that spiked. But on the other hand, this week we've had data that suggests that the US economy and the labour markets are fine. Perhaps, Lexi, could you bring to life some of the data points that you've been looking at this week, thinking about the ADP report, which is looking at the private employment sector in the US, which showed a bit of improvement?
Yeah, like you say, Paul, it did improve. So it rebounded, adding 42,000 jobs in October, and this was well above the 25,000 expected, and following upwardly revised cuts the previous month. So employment was low, but improving, but it wasn't a broad-based improvement. So it was mainly driven by the services producing sector, and annual pay growth was flat.
Great. And I think it's always worth, on the one hand, we've had some weaker data and some stronger data this week. So it's important not to focus just on one data point, but to try and take a broad range of data when trying to assess where the economy may be heading. I suppose we've also had this week the survey data within the US. So this is survey data that surveys both services companies but also manufacturing companies. This week is more focused on the services side. A little bit of improvement there?
Yeah, a little bit of improvement. So these surveys measure employment, prices and inventory levels, and a level of above 50 indicates growth, while a level of below 50 indicates contraction. So services rose to 52.4, and this was the strongest expansion since February and well above expectations, as business activity improved as well as new orders. But employment again remains quite low, with signalling concerns over the strength of the economy, and companies also cited that the government shutdown is causing difficulty in business activity.
I think it's interesting when you dig into the survey and look at the different sectors. You get some sectors performing really strongly, likes of retail, but on the other hand, you've got some sectors, likes of construction, still struggling. But on the whole, face of it, improvement, which is which is great news. I think just to finish off on just thinking about some of the pillars that have underpinned the strength of the US economy, one of them has been corporate profits, which continue to be really strong and underpin the high valuations that we see in US equities. If we think about the blended earnings growth rate coming into the earnings season at the start of Q3 was 6%. It's coming in or tracking 10%, so well above expectations. But also importantly is that the breadth of earnings revisions is positive, not only in the US, but also in the likes of emerging markets and Japan, which is really important that the fundamentals are coming through to justify the strength that we've seen in equity markets this year. Thank you very much, Lexi, and thank you very much for watching. We'll see you next time.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.